Hello everyone, this is a short video lecture on basic consolidation. I will briefly explain the concept of subsidiary, associate, and how to account for them in statement of financial position, because that's the type of question you will get in the exam. Income statement, consolidated income statement is not in the syllabus for year 2. So we will only talk about consolidated statement of financial position. So two concepts we want to look at: subsidiary and associate. So let's start with the subsidiary. Let's first talk about the concept of group. Okay? So what is group? Well, if there are two companies where one company controls the other company, okay, and this control is generally achieved by purchasing more than 50% of ordinary shares or voting rights. So if one company, we call the company which is purchasing the share a parent company, or P, purchases more than 50% shares in another company which is subsidiary, okay, then P will have control, will achieve control over S, subsidiary, okay, and together they will form a group. Okay, so those two companies are considered to be in a same group, like one entity, like one company. They are connected now. What this means is that P can now control S like it was merely a division of parent company. Alright, so P can control S just like that the S is a division or a department of the parent company. So what that means is that the parent and subsidiary will not prepare two separate accounts. Instead, they will be required to produce a joint financial statements known as consolidated financial statements. Okay, so second point is, because they are considered to be a single entity, they will prepare something called consolidated or combined financial statements, FS. Okay, this will include mainly, there are going to be more, but mainly statement of financial position and profit or loss account. Alright, so these two companies together will prepare a single set of financial statements, statement of financial position and profit or loss account. We do not have to worry about profit or loss account because you will study it in the next level. We will talk about the consolidated statement of financial position. So let's talk about consolidated statement of financial position, consolidated SFP. When you prepare consolidated statement of financial position or SFP, what you are required to do is cross-cast all assets and liabilities of parent and subsidiary. So in the SFP, you will have all assets and liabilities of parent and subsidiary. Okay, cross-cast, add up all the assets and liabilities. That's called basic consolidation. You will have to add up all the assets of parent and the subsidiary. As a result of purchase of shares in subsidiary, there will be something called goodwill. Okay, now goodwill arises where parent pays more than what subsidiary is worth. So for example, if the subsidiary is worth only 100, but if parent pays 120, then that extra 20 is goodwill. And we normally do a working for that to find a figure for goodwill. Then we have group retained earnings as well. What this means is that once the subsidiary becomes part of the parent, whatever profit generated by subsidiary after the acquisition, after the purchase, will belong to the parent. Okay, and if the parent has purchased 100% of the subsidiary, then 100% of that profit will belong to the parent. So you will have to find a combined or group's retained earnings by doing a working, which will include parents' retained earnings as well as subsidiaries' retained earnings. Okay. Next point is what you should not include in SFP. So what goes from the consolidated SFP? What do you have to remove? Well, one thing you need to remove is investment in S. You will normally find it in P's books. Okay, you will normally find it in P's parent's statement of financial position. You must not include it in the consolidated SFP. What is the reason? Well, before acquisition it was an investment. After acquisition, in consolidation, you are receiving assets, net assets from the subsidiary in return for the investment, in return for the money you have paid to the subsidiary. The investment is the money you have invested in subsidiary. Now that is going to be replaced by the net assets, what you are receiving from the subsidiary. So if you keep investment as well as the items you are receiving from S, well, you are double counting them, so you should avoid investment in associate. Do not include it in consolidated SFP. Instead, you are going to bring in all the assets and the liabilities of the subsidiary. In other words, net assets. You should not include subsidiaries' ordinary share capital. Okay? This was from P, in P's SFP. You will find it in P's SFP. In the same way, you will find subsidiaries' ordinary share capital in subsidiaries' financial statements, statement of financial position. You should not include it. How to explain it in more simple language? Well, I would say that normally you show ordinary share capital under equity section if that share capital is issued to the general public. Okay, so for example, if you have a company and if the share capital, if the shares are issued to the general public, then you should record it under equity. However, who purchased subsidiary shares? Well, the parent purchased it. They are no longer with the external people, they are with us, and that means we bought our share back, so we cannot include that in the financial statements. They are not outstanding anymore, they are with us. Okay, so we need to eliminate that as well. And the last bit is what you should eliminate. Okay, if it is existing, what you should eliminate or remove from consolidated SFP. Okay, I'm mainly talking about any intra-group or intra-company transactions. Now, according to IAS, we are not allowed to include or keep any intra-company transactions in the consolidated statement of financial position. Intra-company transactions means where the parent has sold goods to the subsidiary or subsidiary owes money to the parent. Those kind of transactions, they are called intra-group transactions. Now, the reason why we eliminate that, the main reason is because after the acquisition, subsidiary is a part of parent. Okay, it's a part of the group. It is a single entity. It is one entity, and one entity, one company cannot trade with itself. Okay, I cannot make profit by selling goods to myself. It would be wrong. It will give incorrect impression about the company to the shareholders. So we need to eliminate those. So in terms of statement of financial position, the things that should go are any year-end outstanding balances between two companies. So if the parent owes something to subsidiary or subsidiary owes something to parent, those should go. Any PURP, provision, let's write it, provision for unrealized profit. Now what this means is that where the parent or subsidiary has sold goods to another company, which is either parent or subsidiary, and made profit on that, now that profit is not realized. It is not actually earned. Why it is not earned? Well, the goods were not sold to the third party. The goods were not sold to the external party. It was sold to itself, and that's how they have made profit, and that sort of profit should be eliminated. So these two things must be eliminated. Year-end balances and PURP should go. I will explain more in detail. Well, let's write it here. The year-end balances should be deducted from receivables and payables. All right. And PURP should be deducted from inventory. Okay, remember that. Right, so that was subsidiary. Let's just quickly revise what we have done so far. Subsidiary. Well, first we talked about the concept of group, where parent controls another entity, subsidiary, okay, and that gives parent control over it, and parent is going to treat it just like another division. So we do not need to prepare a separate set of financial statements. We are going to prepare something called combined or consolidated financial statements. They include consolidated SFP and P&L. Okay, we do not have to worry about P&L. We will just prepare SFP. In consolidated SFP, you are going to cross-cast all assets and liabilities of parent and sub, add up all the assets and liabilities of parent and sub, calculate goodwill and show it as an asset in SFP, consolidated SFP, and lastly, group retained earnings. You do another working for that and bring in to the consolidated SFP. Next we saw was what should go from consolidated SFP. Well, you need to remove two things: investment in S, which you will find in P's SFP, and subsidiaries ordinary share capital. Again, you will find it in subsidiaries books. And you will also need to remove any intra-group or intra-company transactions, okay, from the financial statements. Good, so that was subsidiary. Now let's look at an associate. What is an associate? Well, associate is not a subsidiary, it's an associate. So what does that mean? Well, it means that where the parent owns or controls Okay. I think control will not be the right word. What I meant to say was P has more than 20% but less than 50% of associates another company's ordinary share capital. So if the parent has more than 50% shareholding, then it becomes subsidiary. But here we are not talking about more than 50% share. We are talking about or share ownership, which falls between 20 and 50% somewhere. Okay, so that makes the other company an associate of the parent. Okay, this gives parent something called not control but significant influence over the associate. That means they will have significant influence in the policy decision, strategic decision making in associate. Okay, they have an influence, but they do not have control. So what does this mean in terms of statement of financial position which you need to prepare? Remember, you will get an associate, and if you have an associate, this is what you need to do. You do not consolidate. When I say do not consolidate, you are not going to cross-cast. You are not going to add up all the assets and the liabilities of parent and associate. Do not do that. You do not consolidate or do not add up assets and liabilities of parent and associate. Okay? Do not do that. Big cross. So what are you required to do? Well, IAS 28 permits something called use of equity accounting. What this means is that you're going to treat it as an investment. Okay, and when you have an investment, you show it in one line, just like investment in other company shares, bonds, or bank deposit, etc. So you have to use equity accounting to show it, i.e. you're just going to show it in one line. Well, this one line will come from a working, so you will need to do a working for that. What kind of working? Well, you will need to find the associate, investment in associate at the date when you are preparing the financial statements, which is the year-end date. How do you do it? Take the investment which you made at acquisition date when you bought the shares in associate. You take the investment at that date, and then you add our percentage, parent's percentage in associates profit, or rather we should say retained earnings. Okay, so parent will have share in associates retained earnings which took place after the acquisition. So we should say post acquisition retained earnings. Okay, I think we better put this word here. Post ac. Ac means acquisition. Okay, so post acquisition retained earnings into parent share. That will give you the item to add to investment at the acquisition date, and you will find the final figure, and that will go to your SFP, and you call it investment in associate, and this is your SFP figure. Okay, so this is how you treat the associate. This is what you need to remember in terms of associate. Now, I hope you have understood the basics of the subsidiary and associate. In the next lecture, we'll put it into action. We will solve a past exam question. All right. Thank you.